In this session, what we're going to do now is record the journal entries, part 1 of the requirement, for that example called George. Now, if you haven't seen the previous recording, you need to go back and refer to that example recording for George. So you should already have the transactions, those 8 transactions in April 2009, ready to go in front of you. Now what we can proceed to do is answer the question. Now, the first requirement said that we should prepare the journal entries for each transaction, recording that dual effect for George. So, what is our journal then? Well, a journal is a written instruction to the bookkeeper to update the ledger accounts. Okay, so a written instruction to the bookkeeper to update those accounts. And that's essentially what we're going to do. We're going to write down the dual effect for each transaction and then apply those debits and credits that we learnt with that dead click mnemonic. So let's have a look at the first transaction then. Remember, the first transaction was on the 1st of April 2009. And we said that George invests $50,000 of his own money into the business. Well, remember, George is the owner and he's investing his money into the business. Now, remember the business entity principle. We have to think about this from the business's point of view, not George's own personal point of view. So, the business would now then have $50,000 more cash as a result. Remember that cash, or cash at bank, is an asset. And what we are doing here is increasing the business's asset of cash at bank. So let's write that down. Increase in cash at bank. And I'll just put in brackets there an asset, $50,000. So an increase in cash at bank asset, $50,000. The business has more cash as a result of George putting that money into the business. Now that's one side of the transaction. What about the corresponding dual effect? Well, if the owner is investing money into the business, that is called capital. Okay? So what the business now has is an increase in capital. Okay. Now, capital, remember, that is an element in itself of the financial statement. So that's our capital invested. And again, that will be for $50,000. Okay. So just like you saw in previous sessions, increase bank asset, increase our capital as well. Fantastic. So there we go then. Now what we've got to do is show the debit and the corresponding credit. So this is where you need to look back in your notes where we talked about that dead click mnemonic. Go and have a look. Let's have a think about this increase at cash at bank. An increase at cash at bank is an increase in an asset. An increase in an asset must be, you all guessed it, it must be a debit entry. Increase asset is a debit entry, so I'm going to refer to that as DR. So next to cash at bank asset, I've wrote DR. I'm going to debit the cash at bank account. Okay, so that's the A in dead click. Now, every debit entry must have an equal and opposite credit entry. So, using that rule, an increase in capital must be a credit. But look back to your dead click mnemonic. On the credit side, on the right-hand side, at the bottom, an increase in capital is a credit entry. So that's what we'll do there. So CR, credit, an increase in capital, or the capital account. Okay, so there we are. That's our double entry, the debit and the credit recorded. And we will post those debits and credits to our main ledger, our ledger accounts, later on. But that is our first transaction dealt with. So for George then, let's now have a look at the second transaction. And remember, the second transaction for George, it says that he purchases $5,000 worth of goods on credit. So remember, George is promising to pay his supplier later. Well, if you've purchased goods, that would be a purchase of inventory. Now, purchases appear in your statement of comprehensive income. They essentially reduce your profit. Okay? Purchases is an expense. So if you're purchasing goods to then resell to customers and make a sale out of, a purchase of good is known as purchases and therefore is an expense. So, to record this transaction then, the dual effect, we're going to increase purchases, and purchases is an expense, and that will be with the amount of $5,000. Okay, that's the value of the goods that we purchased. So we're going to open up another account, call it purchases, and increase that expense account with $5,000. Remember, the dual effect. We've got to have the equal and opposite effect of that transaction. Well, it can't be cash because we're not paying for those goods now for cash. So it's not going to be a decrease in the cash asset. Now, because we're purchasing goods from a supplier, and that supplier we probably usually do a lot of trade with, we would probably call that a payable. Okay. Now, a payable is someone who we owe money to, so suppliers who we owe money to. If you remember from earlier sessions, we said that a payable was a current liability. And that's what we need to recognise now. We owe money to the supplier, it is a liability, and we're going to call that a payable. So, we are going to increase our payables liability with the same amount that we just recognised that we owe to our supplier of $5,000. So we're increasing our expense of purchases and also increasing our payables liability as well. There we go. So that's the dual effect recorded. Now what we need to do is show the debit and the credit entry. Again, look back to your dead click mnemonic we discussed in earlier sessions. Now we're increasing a purchases expense. So you can see expenses are the E in that dead click mnemonic. An increase in an expense, what would that be? Debit or credit? I'm sure you're all saying at home, Natasha, it's a debit, so we'll go with that. It is indeed a debit entry. Increase, expense, debit entry. Which means, of course, then that the increase in the payables liability must be a credit. But again, look back at your mnemonic. An increase in a liability must be a credit. So always use that mnemonic to help you. And it's something essentially that you have to remember in order to be successful in this exam. Let's have a look at transaction number 3 then. And in transaction number 3, we were told that he sells half of that inventory for $6,000 cash. So we're selling the goods in return for cash. So, of course, we must have an increase in our cash at bank. And remember, cash at bank is an example of an asset. $6,000 would be that amount there. So, selling the goods, receiving cash in return. Now think about that word that I just mentioned. Selling. We are selling goods in order to make profit, because in this syllabus we'll be looking at commercial profit-making businesses a lot of the time. So what we need to do is record the fact that we've generated some income, sales income. So what we're going to do is increase sales. So we're opening up a new account called sales, which is an example of income. Remember that income go into your statement of comprehensive income to help you work out the business's profit or indeed loss for the year. And that would be for the same amount, $6,000. Again, we've recorded the dual effect. Now let's apply the debits and credits to it. An increase in an asset of cash at bank. What do you think? A debit or a credit entry? Well, you must be right. It has to be a debit entry. So DR, increase in an asset is a debit entry in the same way that the first transaction was as well. Now let's have a look at the increase in sales. Obviously, we know it has to be a credit because every debit must equal a credit. But why? Well, let's look at that dead click mnemonic. On the credit side, income. If we're increasing income, credit. Okay, so an increase in income must be a credit entry from our dead click mnemonic. There we go. So that's our credit entry. And that would be our third transaction, the sale now complete. So then, let's carry on. Let's proceed on to the fourth transaction. And this fourth transaction says that he issues a check to pay for the goods he received on credit. So now George is settling that amount, that payable, that he owed to his supplier. So let's have a think about this then. If we are settling an amount that we owe to our supplier, we are effectively reducing our liability. So our first effect will be to reduce our payables liability. And that would be for the amount that we received the goods for. And we said back in transaction number 2 that that was $5,000. So if you're paying it, you're settling it, you do not owe that money to the payable anymore. So you wipe it clean and reduce that liability down. How are you going to reduce it down? Well, you're going to pay cash for it, aren't you? You're going to give that supplier cash to clear that amount that you owe to them. So we're going to decrease cash at bank, remembering that that's an asset, with that $5,000. Dual effect done. Now let's apply the debit and the credit. A reduction in a liability. Now this is the first time we've seen a reduction. And remember that dead click mnemonic, we said that for increases in assets, liabilities, income, expenses, capital and drawings, that dead click would always apply. What about, though, if we decrease? Well, if we decrease any of those types of accounts, essentially dead click would be reversed. Now, if you're increasing an asset of cash at bank, for example, that would be a debit entry. But if you are now decreasing your asset of cash at bank, well, that would be the credit entry. Okay, so the opposite. Remember, debits and credits are opposite. And look, you know, we've seen that here now. That reduction at cash at bank must be a credit, the opposite to an increase. Which means then that reduction of the liability of payables must be a debit. An increase in a liability is a credit. A reduction in a liability, well, that must be a debit. So for decreases in the account, dead click is reversed. So then, that's the 4th of April transaction now complete. Let's continue on. On the 5th of April 2009, he pays his rent for $450 by cheque. So let's have a think about what we're doing there. Now, if you're paying rent Rent is essentially a business expense. You need to incur that expense in order to run your business. Now, just like purchases was a type of expense, rent would be a separate category of expense away from purchases. So, we're going to have an increase in the rent account, which would be an expense. And that would be for $450. Now, how are you paying for that rent? Well, you're paying for it by cheque. Well, what you need to do then is to decrease your asset of cash at bank. So decreasing your asset of that cash at bank. Okay, so dual effect settled again. You're paying for an expense in cash, increase the expense, decrease the cash asset. Dual effect then, increasing rent expense. Look at your dead click mnemonic. Increase expense must be a debit. That's the E in dead click. So we're going to debit the rent expense account with that increase in an expense, which means, of course, again, we're going to credit and reduce the cash at bank asset. Next transaction then, on the 6th of April 2009, he sells his remaining inventory for $6,000 on credit. So again, George has made a sale, but not for cash this time. This time, it is on credit. So we're selling goods to the customer, and we're saying to the customer, you can pay us later. Now, essentially, that customer owes us money. That's a good thing. As a result, what we would need to do is recognize an asset. Okay? That asset will be known as a receivable. Customers who owe us money. So, we're going to increase our receivables asset by the amount that we've sold the goods for, which was $6,000. Okay, so we're increasing our receivables to recognise the fact that we are owed money and will receive cash in the future when that customer then pays us. We're still making a sale though, so we're still going to increase our sales account, which remember is a type of income account. And again, that will be for the same amount, $6,000. The dual effect would still balance, still work. Debits and credits then. To increase an asset, asset must be a debit entry. It's the A in dead click. So to increase an asset, that would be a debit entry. Which means then that the increase in sales must be the corresponding credit entry. Okay, so that's our 6th transaction dealt with. Nearly there, only 2 left to do. Let's have a look at transaction number 7. Now, transaction number 7 states he purchased goods on credit for $7,000. So again, this is another transaction with a supplier to purchase goods, and again, we are promising to pay later. So, what we need to do then, if we are purchasing goods for resale, we're going to increase our purchases expense account with the value of the goods of $7,000. So increase purchases expense because we're purchasing goods for resale. Now we're purchasing these goods again on credit, so what we need to do is recognise a payable. So we're going to increase our payables. What type of account is a payable? Have a think. It's going to be a liability. The liability be $7,000. Again, the dual effect works. Now what we need to do is do the debit and credit. Looking at purchases first of all. An increase in our purchases expense. What do you think? Debit or credit? I'm sure you've all seen this. We did do this same transaction on a previous one. We did that in transaction number 2. That would indeed be a debit entry. An increase in payables liability then, well, that has to be, of course, the credit entry. Every debit must have an equal and opposite credit. Okay, so our final example then, our final transaction for George that we need to do the journal for. Well, we can see then that he purchases a delivery van for $7,000 cash. So, how are we going to record the dual effect? Well, what's happened is he has purchased a motor vehicle. Remember, that's an asset, so the motor vehicle being the delivery van. And the business has now got that asset in its business. So the first side of the dual effect is we're going to increase our motor vehicles account. So it's a different type of asset. And we're going to increase that account by, again, $7,000. Okay, so the business now has that asset. We're going to increase that asset account up. Remember, for each different type of asset, liability, income, expense and capital, we need to have a separate account for each different type of asset, liability, etc. Now, as a result of receiving that motor vehicle, we've paid out cash. So, again, what we're going to do is reduce our cash at bank asset, and we're going to do that by $7,000. Again, so the dual effect indeed works. So, that's the transaction and the dual effect recorded. Now let's do the double entry. So, to increase our motor vehicle's asset account, increase an asset, well, an asset is the A in that dead click mnemonic, that would be the debit entry. Okay, so DR, debit for the motor vehicle's asset account. Which means then that our reduction in the cash at bank account, that would be the credit entry, and that would be the debit and credit dual effect now recorded. So that's it then. We've done our 8 transactions. We've wrote the journal for those transactions, recording that dual effect. We're given that instruction to the bookkeeper. Now what we need to do is prepare the ledger accounts. And we're going to do that in our next recording.